Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 650 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Today, we're diving into a question that's been buzzing among Singaporean investors. Should I buy ST Engineering at $5? Now, ST Engineering isn't just another stock on the SGX, it's one of Singapore's most iconic companies. If you've ever wondered whether this is a good time to invest in it or if it fits your portfolio, stick around because we'll break it all down for you in simple terms. Let's start with why ST Engineering is such a big deal. This isn't your typical company that makes one product or operates in one industry. ST Engineering is like a Swiss Army knife. It has multiple business segments that generate revenue. It operates in 4 main sectors: aerospace, electronics, land systems, and marine. Think about it. Planes, smart tech, military vehicles, and even ships, all under one roof. This diversification means that even if one sector faces challenges, the others can help balance things out. For example, during the pandemic when aerospace companies were struggling due to fewer flights, ST Engineering still had its defense and electronics divisions performing well. Now let's talk about its financial health because numbers don't lie. In 2023, ST Engineering reported a revenue increase of 17% year-on-year to hit $9 billion. That's huge growth at a time when many companies were grappling with inflation and rising costs. And here's something even more impressive. Its order book stands at $25 billion as of now. What does this mean for you as an investor? It means the company already has contracts lined up that will bring in revenue for years to come. Imagine running a business where you already know how much money you'll make for the next few years. That's the kind of stability ST Engineering offers. And let's not forget who owns a big chunk of this company: Temasek Holdings. If you're not familiar with Temasek, it's Singapore's sovereign wealth fund and one of the most respected investment firms globally. When Temasek backs a company like ST Engineering, it signals strong government support and financial stability. This is especially important for industries like defense and aerospace that require long-term investments and are subject to strict regulations. So why should you care? Well, if you're someone who values stability and consistent returns in your portfolio, ST Engineering could be worth considering. At $5 per share, it offers a dividend yield of around 4%. To put that into perspective, the average interest rate for CPF ordinary account savings is 2.5%. Even if you compare it to high-yield savings accounts in Singapore offering about 3%, ST Engineering still comes out ahead with its dividend yield, and that's before factoring in potential capital gains if the stock price rises. Let me give you an example to show how this company delivers results in real life. Recently, ST Engineering partnered with the Singapore Armed Forces to modernize military equipment using advanced robotics and AI technologies. This isn't just about making tanks or drones, it's about staying ahead in innovation and ensuring Singapore remains a leader in defense technology. Thanks to this initiative, ST Engineering secured over $1 billion in new contracts last year alone. This shows how the company isn't just sitting back, but actively growing by tapping into cutting-edge trends. But before we get too excited about buying ST Engineering at $5, let's take a step back and consider some risks, because no investment is without them. First off, rising operating costs could eat into its profit margins. While the company has been resilient so far, global economic uncertainties, especially in sectors like aerospace, could pose challenges down the road. For instance, if airlines cut back on spending due to slower travel recovery or higher fuel prices, it could impact ST Engineering's aerospace division. Another thing to keep an eye on is supply chain disruptions. We've all seen how delays in getting parts or materials can affect businesses since COVID-19 shook up global trade routes. For a company like ST Engineering that deals with complex projects requiring multiple components from different suppliers worldwide, any disruption could delay project deliveries and revenue recognition. And then there's valuation. This is where things get tricky. At $5 per share, some analysts believe the stock may already reflect its growth potential based on its current earnings and order book size. This means there might not be significant upside unless the company exceeds expectations by securing even more high-value contracts or finding new growth areas. So what does all this mean for you? If you're thinking about buying ST Engineering shares at $5, start by asking yourself what your investment goals are. Are you looking for steady dividends to supplement your income? If yes, then this stock could be a good fit given its stable business model and attractive yield compared to other options available locally. However, if you're someone who prioritizes high growth over stability, like investing in tech startups, hoping they'll become the next big thing, then ST Engineering might not be the best choice for you right now unless there's a significant dip in price that makes it more attractive. To make things clearer, think of investing as choosing between different types of durians. Yes, durians. Some people love Maoshan Wang for its rich flavor, high-growth stocks, while others prefer D24 because it's consistent and reliable, dividend stocks like ST Engineering. Both have their merits. It just depends on what suits your taste buds, or in this case, your financial goals. Now let's wrap things up with some key takeaways. ST Engineering is a strong player with diversified revenue streams across critical industries like defense and aerospace. Its government backing through Temasek Holdings adds an extra layer of stability that many investors find reassuring. At $5 per share with a 4% dividend yield, it offers decent returns for those seeking income-focused investments. But remember, rising costs, supply chain risks, and valuation concerns are factors you can't ignore when making your decision. Always do your homework before investing. Read up on market trends, check analyst reports if needed, and most importantly, make sure whatever decision you make aligns with your financial goals. If you found today's video helpful or learned something new about investing in Singaporean stocks like ST Engineering, don't forget to give this video a thumbs up. Subscribe to the Investing Iguana for more content tailored specifically for Singaporean investors like you. Before you go, check out my next video where I'll be diving into why top analysts predict big gains for ST Engineering. We'll explore why this multifaceted powerhouse from aerospace to smart cities and defense tech is turning heads on Wall Street, shedding light on the reasons behind the unanimous strong buy rating from 6 top analysts. We'll explore ST Engineering's game-changing contracts, crunch key financial numbers, and peek into their crystal ball for future growth. Thanks for watching, and as always, happy investing.